Okay. So we are live. And I'm seeing thumbs up. What does that mean? Oh, it's Trisha.
Can you see how many people are joining?
I don't see that. Give it just one more second. Let me check.
I'm looking at my land manager. Am I on?
Oh, hold on. How do I turn it off now? Okay. All right. See, look, Trisha can see us now. Okay, cool. So we're going to go ahead and kick this off. Are you ready?
I'm ready.
Okay, well, there are a lot of people watching, so don't mess up, okay?
Well, this is my first podcast. Why not do it live stream in the most historic week in oil history?
It's a good time to start. Well, good morning, everyone. Thank you so much for joining. I'm Catherine Mills, and you are listening to the Crude Audacity podcast, the podcast that talks shop shit and all things strategy with oil patch influencers. Today, I'm joined by my good friend, Miss Whitney Wickes, out of Sheridan, Wyoming. For those of you who might not know, Whitney is an entrepreneurial powerhouse in the oil field. She has been Forbes Top 30 Under 30 twice, and she is now currently the COO and co-founder of Rocking WW Minerals, again, up in Sheridan, Wyoming, which you moved up there about 6 months ago, yeah?
Yes, we relocated from Denver in June. We've been focused on Rockies assets for a long time, and specifically Wyoming. We love the state. And so we decided to pick up and move here and staff up here. It's awesome. I love it here. I actually have a pretty funny story, Wyoming story that happened to me last night.
A Wyoming story?
Yeah. So super different from living in Denver. Here's a good example. So I live in Bighorn, which is an unincorporated community just right outside of Sheridan.
The middle of nowhere.
Yeah. And I love it that way. So I got neighbors, but they're far away. We all have 5 to 10 acres, whatever. And at about 11 o'clock last night, my dog started barking, which is unusual. And so I opened the door, and my neighbor's horses had gotten loose, and they're in my yard. And I don't mind, but I'm worried that they might wander along the busy road at some point. And so trying to figure out how to contact my neighbors, I finally drive over there, and they start walking back. They don't have any halters. There's 2 horses and 1 donkey. And so I wrapped my dog leash around this donkey's neck, and I'm trying to drag this ass named Molly back to her house at 11 o'clock at night. She does not want to go because my grass looks a lot better than hers. So it takes about 20 minutes to pull Molly back to her house. Yeah, that's a typical night there in Wyoming.
So you were dragging ass last night?
Yeah, I was. That's why I'm tired today.
Well, awesome. Well, thank you so much for joining. I'm so excited to get your perspective because, as you know, we hit rock bottom and drilled straight through it on Monday. And given your background in the energy space, it's been an industry that you have loved, hated. It's kicked you in your teeth. You've come back guns a-blazing. So just to kick us off, no one should be surprised about what happened on Monday. It's been touted for a long time that it is time to shut in. We need to be prepared for being under $10 a barrel. What was interesting was the fact that we hit zero and then drilled straight down to -40. So from your perspective, what was the perfect storm that caused this? What was happening in the market in the weekend before and the weeks before that led up to it? Can you give us you and your partner's insight?
Yeah, sure. So, there's the obvious background, which is COVID and the ego wars going on, at OPEC, but our industry was in trouble before this, just exacerbated it.
In trouble for a while.
Yeah. So at the end of 2014, we're in ICU, and we went through that downturn, and we came out of ICU and the downturn, but we stayed in the hospital. A lot of the companies that came out re-levered themselves. In fact, about the companies that survived the last downturn, their debt makes up about 10% of the junk bonds right now. So, we didn't really fix our problems. We were investing in bad rock that weren't really economic, at even, $50, $60 oil. So things weren't looking so pretty anyway. I think everyone was kind of bracing for another pseudo downturn. Then along comes COVID, which is by far the biggest catalyst in this whole mess. And OPEC, just added insult to injury, those brief ego war, between Saudi Arabia and Russia. And then, agreeing to that $10 million cut was a little, was too little, too late.
Yeah, exactly.
What we saw with these negative prices happen, and, it's easy to say that we didn't see that coming, but obviously the traders did, because CME actually changed their systems at the beginning of the month to be able to take negative pricing. And negative commodity pricing on the futures market isn't unheard of. Natural gas prices have been traded negative. Gasoline has been traded negative. Anything that typically runs into a storage shortage will eventually trade negative. And so what we saw happen on Tuesday is, the May contract coming up, on close. A lot of people, so it's kind of counterintuitive, because you see, okay, negative prices, that looks like it must have been some sort of, bearish reaction, to the market, but it was actually created by a bullish reaction where you had a bunch of investors, individual investors jumping into the ETFs that didn't really understand them, betting that they were getting in at bottom, betting in that the contracts were going to close higher than they were. But lo and behold, we run into storage issues, where the traders left with a contract, that maybe typically could find storage, can find storage. And then a lot of folks, didn't even realize, that they had to assume delivery of the crude. If they were kept the contracts, didn't know what to do, ensued, panic, and they had to pay people to take oil off their hands.
So what do negative oil prices actually mean? Because like you said, this is not new in the future space. So what are the impacts of the industry for the negative?
Yeah, I mean, so the intrinsic value of oil isn't really zero. Oil is never worthless. It can only go negative because of, financial market mechanics. And so, the storage companies, they're going to make hundreds of millions of dollars, in this. And so you ask them if they think, oil is worthless, and, their financials in a couple of months are going to tell you otherwise.
So someone's always going to get rich on one end of the spectrum.
Exactly. There's somebody on every side of a bet.
Well, talk to us about the rumors that, we went negative here this week in April, but May and June are expected to be just as bad, if not worse, because of the storage issue. So what are you guys bracing for?
So Cushing is about 80% full right now, and the remaining 20% capacity has been leased. So we're expecting to probably fill all that storage by the end of the month. So we will run into the same issue when it comes to June future contracts that are, expiring at the end of May. And hopefully, the traders have learned a bit from Tuesday. I think a lot of people lost a lot of money and got pretty burned. Yeah. But, in any volatile market, there's always people willing to take bets. So I'm sure there are people that are going to be going long. But, hopefully, this storage problem, is becoming a reality to a lot of these traders. And they'll be a little bit more bearish than they were this last go around. Hopefully, once you get further out and you start looking at July, August, September contracts, hopefully won't see it go negative, as the economy begins to recover and we start drawing down on storage a bit, that should hopefully alleviate the risk of it trading negative again.
So, I mean, are we going to go negative again even this month?
Yeah, I mean, it very well could. Again, we have nowhere to put it. And so inevitably, if there's people long in the market, I don't know where that's going to go.
Well, you're seeing in the news this like, I guess, the hope that this OPEC plus negotiation is going to work out and it's going to be the small saving grace for the oil field. But what I'm seeing is we've got impacts from Mexico, Russia, OPEC saying we're cutting back. But what is the United States cutting back? Because that's where we got ourselves in this mess to begin with. I mean, in order to handle this reduction in demand, there has to be something that pulls back the oversupply.
Yeah, I think the U.S. has been its own worst enemy, when it comes to production, and we've always kind of seen OPEC as a kind of lifeguard that they're gonna save us, and cut production and help bring back up prices. Obviously, in COVID, this is a whole different scenario. I don't really think, any additional cuts OPEC's going to do is not going to make oil rebound. It may, obviously it'll help and it'll decrease, production quicker, and we may draw on those, those storage, those stockpiles sooner, but it's really not going to have a profound impact. I mean, this week we saw just in the U.S. 50 million barrels added. And I think we're up to like 519 million barrels of storage. Mm-hmm. It's going to take a long time to draw this down. Going back to what is the U.S. doing? So the U.S. is obviously unique from the rest of the OPEC countries because, we're a free market. We are a capitalistic free market, whereas obviously, the OPEC countries, their energy industries are controlled by the government. But the U.S. should organically cut production by necessity. We can't make money at these prices. I don't think any operators want to be producing at these prices unless they're really well hedged. But if they're not well hedged, it's in no one's best interest to keep producing. And so, like what the Texas Railroad Commission is doing, trying to kind of be a smaller version of OPEC in Texas and get the companies to cut production. I don't really think that's the answer. I think the better answer is what we saw OCC doing and saying, okay, producing in this uneconomic environment, that production can be categorized as economic waste, which now allows operators to shut in production without, fears of, losing leases. Mm-hmm. So now the remaining fears are, if they've got minimum volume commitments, and can't get out of those, if they've got certain, they've got debt payments they're making that they have to have cash flow for, G&A, if they've got high fixed expenses, that they have to continue to produce for. Other than that, I don't know why anybody would want to be producing right now. And I think everybody would like to shut in unless they're really well hedged and they can, essentially capitalize on this down market. And, if they're hedged at, let's say 50 or 60 dollars a barrel, right now, they're making that and they still get to pay out royalties at spot price. So the markets are huge right now.
So your opinion is that these proposed cuts, these potential cuts that we'll see in May from the OPEC and OPEC plus are not going to have the desired impact, or at least for a while, because of this approximately 38% reduction in demand. You don't see the upside of this this new development, this new piece of the puzzle?
I mean, of course, there's a little upside, just like there was when they cut the 10 million barrels a day. It's definitely going to help, the industry recover sooner. But again, it's not going to have a quick impact. It's not going to bring us out of where we are. We've got too much storage that we've got to draw down before we really see the impacts of these production cuts.
Mm-hmm. Do you think demand is ever going to hit back where it was? I would say it's going to take quite a while to see that 100 million or 100,000 barrel a day daily use of petroleum. So what are your thoughts there? How is demand going to react to this current COVID situation?
Yeah, I mean, I'm sure demand at some point will go back up to 100 million barrels a day. I think that the EIA, obviously their report came out before this whole COVID crisis, but they're anticipating from 2018, which was about 100 million barrels a day, to 2050, that demand was going to increase to be about 127. Now, obviously, the growth isn't coming from, OECD countries. It's not coming from the United States. It's not coming from Europe. It's not coming from the first world countries. The growth is coming from the Chinas and the Indias of the world, the non-OECD countries, specifically in Asia. And so those are the markets we're really going to rely on, to bring demand back up.
Interesting. So what does this mean for buying, selling assets? We've got companies on the verge of bankruptcy. Assets are worth everything still. It's easier to buy the company at this point. But this is a different situation. It's not two guys and a cell phone deciding they're going to scoop up some cheap assets. And my argument is that the money, or at least private money, has been waiting for a downfall like this for about 5 years now. So what do you see changing in that space?
So private equity, really jumped on board, the upstream industry in 2014, really believing in this shale revolution. And so that's really when they jumped in this game. And then, in the last downturn, kind of to what you're saying, you had this money waiting there. So in 2017, there were 32 funds raised. In 2018, there were 20 funds raised. In 2019, there were 12 funds raised. And this year, there's only 2 funds raised. And that's because the private equity model is effectively broken. What they were doing and getting away with was this buy low, prove up, and flip concept, which worked well for a couple of years, and especially in places like the Permian and the Scoop Stack.
It's kind of lucky.
Yeah, but a lot of that money that was invested in bad rock. So a lot of those investments actually turned out uneconomic. And so when they weren't able to sell to the bigger fish, and the public stopped buying these different positions from the private equity firms, suddenly what was supposed to be a 3 to 5 year private equity cycle turns into a produce out strategy. Yeah. But unfortunately, the produce out strategy doesn't work in uneconomic rock. And so I think you're not going to see as much private equity investment as you would expect. And that's just because, they've been hanging on by a thread again, even before COVID. And even, before these OPEC wars, the private equity companies have been dying on the vine. And so you've got some funds still, again, the few funds that have been able to raise money, have management teams that they've either backed or they're ready to back. But I think, they're pretty risk adverse at this point, and they're going to be really patient. I know from our perspective and our sponsor, we're kind of one of those companies that's going to look for investments in this downturn, but we're going to remain really patient and really objective. It's easy. If you want a deal that bad, you can make any deal look good, but you really have to be disciplined and look at it, black and white, and look at the draconian situation or scenario and say, if oil were to stay at 35 for the next couple of years, you're just looking at strip. If I run this asset at strip, can I make money on it? Mm-hmm. And that's a tough question to answer right now.
Well, how is the face of private equity going to change? Because for many of us, that's what we're used to. That's the economic model. And, we weren't seeing the private investors like we had, or at least to the extent that we had prior to the shale boom. So what do you think's changing there?
Yeah, again, I think investors are afraid of oil. I think it's really hard to raise money in upstream for these funds. And, it's going to have, for companies to invest right now, it's going to have to work on a produce out strategy. They can't buy companies with a 3 to 5 year exit in mind anymore. Mm-hmm.
What's changing in the mineral space for you guys?
Yeah, so the mineral space is going to be a really interesting one in this downturn. It's pretty new. It really exploded in the last downturn, and people got really excited about minerals and kind of shot off into its own segment. So between 2014 or 2015, 2018, you had like $15 billion of private equity poured into these mineral companies. You've got 6 public mineral companies right now, 3 of which IPO'd in 2017. One Brigham IPO'd in 2019. So aside, from Blackstone and Dorchester Minerals, we haven't really been through a downturn where you've had a lot of, big mineral companies. So I think there's a lot of questions there. They haven't really been talked about much. And I think it's because, we don't really know, how well those companies are going to weather the storm. Obviously, they don't have, they have a lot less cost than the E&Ps. They're not drilling wells. They don't have, a ton of overhead. But the other thing is they're not in control of their development.
Correct.
If you look at Blackstone, 30% of their portfolio is producing. 70% is not. And so you look at what's going to happen over the next couple of years, and assuming not a lot of development happens, how are they going to replace those cash flows? And so, they're not in control of the development timing. And as the rigs are laid down, they don't have any way to replace that declining production. And so that will kind of be interesting to see, what happens to these mineral companies. Now, hopefully, what they've done is invested in really good rock under really good operators that are going to be the first, areas kind of return to as the rig starts to pick up. And then, the other big question mark is that private equity side of minerals.
Yeah.
What's going to happen? Because again, unlike, your private equity backed E&Ps, they have low cost, low overhead. And so why would a private equity company, want to sell their mineral portfolio right now when they know that in a couple of years it's going to be much worse than selling it today? And I think you're going to see probably a lot of consolidation there under private equity funds. You're going to see them start to consolidate companies.
We're already seeing it for one reason or another.
Yeah, I mean, it can be run by a small group of people on autopilot if need be, which is unique because, you don't necessarily need an experienced engineer or an experienced geologist once you have these assets. You just need a team to be able to maintain them from the land side.
That's true. So lucky landman.
Yeah, it's a lot of landmen in mineral space.
So what do you think is going to be the outcome of the new face of the oil company? Just lean, lean, lean. I mean, we're seeing layoffs across the board. We're seeing layoffs in reaction to what happened on Monday. So what is the next, year, 6 months, Q2 of 2021 looking like in terms of the face of an oil company, a service company, any fringe tech companies? What's changing?
Yeah. I think it's going to be a really tough couple of years. I think it's going to be a much slower recovery than what we saw in the last downturn. I don't really think you're going to see, there's not going to be a need for production increases until the end of 2021 or maybe even into 2022. Mm-hmm. You're going to see a ton of bankruptcies. There's going to be, there's been estimates of 40% to 50% of companies are going to default in the next 12 months. You have $86 billion in debt coming up on maturity in the E&P space between 2020 and 2024. On the services side, you've got about $32 billion in debt coming up maturity, 2020, 2024. But in reality, a lot of that's going to come up before 2024, because once these companies have to do, borrowing-based redeterminations every quarter, they're going to have breached their covenants, and they're going to default. Mm-hmm. And so, there's going to be a ton of carnage. And, it's going to be extended because even as prices begin to rebound in hopefully 2021, the hedge situation is mind-blowing. We've got about 2.5 million barrels in the public E&P space hedged right now of daily production. And that falls off dramatically. In January of 2021, I think it drops to like 400,000-ish barrels hedged right now.
So what's the result of that?
What?
What's the result of that then?
Yeah, so, and you'd be surprised at who's unhedged next year. I mean, you got the EOGs, you got the Chesapeakes, you had the WPX, you had the Marathons, you have, Oventive, who, by the way, new name sounds like a birth control.
It is a birth control.
Their hedges fall off. And so what you're going to see, what that causes is they're going to be able to survive, 2020 and be able to kick the ball down the road. But, a lot of these fields aren't economic to produce, assuming next year, if you look at strip's going to be 32, those fields are economic to produce, at 32. And so you're going to see like a whole second wind of bankruptcies start to happen as well in 2021.
So you've been through bankruptcy. You have a personal story with it. Can you give us a little insight there? Because, people are beyond in crisis right now. Companies are in complete crisis. So from your personal perspective, how did you manage?
Yeah. So, bankruptcy is such a tough situation, for every company. But my experience, I did go through a bankruptcy when I was working for a Balkan operator in 2015, 2016, 2017. We filed in 2016, and, it was from a, work perspective, it was some of the most challenging 9 months of my career. I was thrown into a leadership position maybe before I felt like I was ready. And I was given, I had to take on accountability for things that I wasn't even there, and they happened. All these erroneous claims get filed saying you've reached this farm out agreement that somebody did, 4 or 5 years ago, and you owed them, $10 million, and then the attorneys come to you and they say, this is a claim that so-and-so just filed, what do you have to say about it? You need to write a memo and how you defend it. And it's super challenging, but I wouldn't take back that experience for anything. I mean, I think that was had a huge impact on my career. It was a big, it was a pivotal point in my career, I think. And I wouldn't be where I am today, and I don't think I would have, my education would have accelerated like it did if I hadn't gone through that bankruptcy. And so, my advice for anybody that's going through bankruptcy, or maybe, going through a restructuring, and try to avoid bankruptcy, is that, you've got to work hard. Just put your head down, work hard. It's hard, it's very demoralizing, and you come to the office every day and everyone's feeling deflated and everyone's scared, am I going to be next? But be that person that comes into the office and has a smile on your face and kind of lifts up the office atmosphere, and work hard. If you love this industry, downturns like this can present huge opportunities, because once companies start to lean out, if you're really good at your job, that'll show. If you're not so good at your job, that'll also show as well. And so, you could take advantage of opportunities in terms of career advancement or just, education. You learn so much during bankruptcy. Again, that was the pivotal point for me. I remember, when we started the stalking horse process, which is a process when, you start to get different potential buyers coming in and giving presentations. And as a landman, I think we get so focused on our own world, and we think that we have more to do with the overall operation of the asset than we do. And I remember being in those meetings and realizing that the questions that the buyers had were more about, remaining oil in place, type curves, what the break-evens were at 20% IRR. They were all engineering and geology focused questions. And I was like, wow, I guess, that's where a lot of the value is. It's not in the land. And so that kind of is what facilitated, I think, my passion for trying to understand and connect the dots across the industry as a whole. So that'd be, I guess, that's my take on bankruptcy.
Thanks for the insight. I'm glad you actually had some personal experience in it, because the stress that is in industry right now is just, it's heartbreaking to a certain extent. But switching gears a little bit, one thing we're seeing come out of, I'm going to say the last 4.5 months, is what I'm calling the shut-in movement, the call to shut in. And I am definitely one, I completely believe that that is the hand that the US has to play, because unfortunately, we have proven time and time again through multiple oil wars that we do not control the tap. And in order to manage the oil field as a whole and to reduce volatility, you have to control the global tap. And in many cases, that is the global conventional tap. So because Russia and Saudi, let's call it a pissing match, but I don't know that the US was just collateral damage. I would definitely say that we were intentional damage. They wanted to hurt the shale plays, and they turned on the tap to do so. So this call to shut in, it's rational, but since we do not act as rational beings, what are your take on it? Because it's not that simple as just saying, go turn off a wellhead. There's mechanical issues with reservoir. There are contractual obligations through lease agreements. So what are you seeing? What is your feeling on this shut in, this call to shut in?
Yeah, I mean, the call to shut in, everybody, I think, like going back to what I was saying earlier, I think everyone wants to be shutting in that can. Nobody wants to produce and pull oil out of the ground, you know, at $10 a barrel or $15 a barrel, or even $20 a barrel.
We hit 15 this morning.
Yeah, and it's, I mean, even if oil's at $15 or $20, you know, a barrel, what's your differential at? You still might be in the red, you know. So it changes obviously basin by basin what operators may, what price they may be willing to produce at. You know, but we've got to shut in production. You know, last week, production only declined by about 100,000 barrels a day. You know, and storage increase, or stockpiles increased by 50 million barrels a day. So clearly we're not doing enough. You know, we need to be shutting in, you know, 2 million plus barrels a day eventually. You know, and I think, you know, operators are trying. Again, there's certain things that are prohibitive, you know, again, whether that's, you know, MVCs or lease terms. And, you know, what the states need to do, they need to come in, like I said, OCC, and say, you know, we believe that this is economic waste, you know, and therefore you've got a, you know, reason to shut in these wells and hold your leases. And, you know, as a mineral owner, I don't want oil being pulled out of my minerals either at $5, $10, $15, $20 a barrel, especially if we think that it's going to go to $30 next year. I'd rather our operators shut them in. So we're actually sending operators letters, you know, the head of the state saying, you know, you can shut in production on our wells for the next 3 months, and we can potentially renew that with them to try to take off some pressure. Now, obviously, if you're just one owner in a DSU, you know, they're going to have to get other folks to do that. But we're hoping we can kind of be, you know, good influence on those. The other complication is that you have these federal plays like the Powder River Basin that we're in. Yeah. You know, and every DSU in the Powder River Basin, you know, so New Mexico is going to be experiencing some of the same problems. Then you've got, you know, areas of Bakken that are, you know, federal as well. But, you know, you've got a patchwork of fee and fed. And so in any given DSU, you've got fed, you know, minerals, which means that that DSU is truly governed by the Code of Federal Regulations. And unfortunately, you know, the feds have taken a tough stance on shut-ins. And, you know, they've got strict 60-day COP clauses. And so, you know, that cessation of production clauses. So when you go to shut in a well, you know, if the field office is doing their job, they're going to catch that pretty quickly. And then what they're going to do is send you a plug or produce letter. And operators in Wyoming have already started to get those, which makes it really tough. You know, and the DOI has kind of taken a passive stance on this. Like, look, we're just looking to the Code of Federal Regulations. We don't think we need to come out with any specific instruction memorandum, you know, to fix the situation. Mm-hmm. You know, but the DOI, you know, and BLM, you know, I think they do need to look at it, you know, from the same way. And they're not going to be making, you know, money on their minerals with oil being pulled out of the ground at these prices either. No. You know, they're part of this industry. You know, they need to step in, I think, and they need to help take the pressure off of the operators as well. Going back to your question about, you know, potential problems with shutting in. Yeah. You know, I'm obviously not an engineer, you know, and I think the problems of shutting in, you know, are lessened in the conventional fields where you have, you know, high porosity, high permeability, you know, the reservoirs flow pretty consistently. When you get into the unconventional reservoirs, and that, that obviously tight rock, we've got to frack it for a reason.
Yeah, exactly.
In the conventional reservoirs, your connectivity to the reservoir matrix, can be a problem once you shut in those wells and once those fractures can, stop talking. The other problem you get into, is with, the artificial lifts and with ESP, which is, the electrical submersible pumps, which typically have, an 18-ish month, run life. And so, you run into problems there as well. But you being a reservoir engineer, why don't you hop in with some potential problems, you can encounter when shutting in wells, trying to bring them back online?
That's why I'm the host, right? I don't typically get asked the questions. So,
taking advantage of you.
High level, I would say that it's a huge modeling issue. You're going to have wells that just are not possible to be shut in because of settlement issues. And there has to be a strategic method, to your point, about considering fracture communication and the way in which, the pattern in which you shut in. So I don't know that modeling can do all of that successfully, quickly. I commend these pop-up shops for trying to make a quick buck and figure out a way and, come in as the technical team. But it really takes someone who has not necessarily subsurface experience, because remember, as a reservoir engineer, my job ends at sand face. Past that, it is the production operations engineer. So if you have a technical team coming in, you want to make sure that the person making the decisions is an operational background with a very well-versed subsurface background, so that you can combine the two. Because the reality is that when you shut some of these in, the workover cost to bring them back online might not be worth it. So shutting in an unconventionals into some conventional assets that we see up in the powder, there's going to be some long-term, damage that we have to prepare for. And what that's going to do is, again, go back to the contractual obligations that we're not going to be able to successfully just turn it back on and start fulfilling again. So back to you.
Yeah, see, you can answer your own question.
I know enough to sound dangerous. How's that? So going back to the retaliation movement that we have in this oil war, it is to shut in. So potentially, let's say we get companies to shut in. What does that look like in the next, 6 months? Pulling offline, pulling back online what we can. What is that going to actually do to the market and to the current situation?
Yeah, I don't know if it's so much a retaliation, because shutting in production is good for everybody. It's good for, all the OPEC countries. It's good for us. I think about a third of the wells, the oil wells in the Bakken, have already been shut in, and I think it's about like 260,000 barrels a day that they've shut in so far. Other basins are starting to follow suit. I think that, and again, this is a necessity. We need to cut production in order to bring back demand. We're not going to level out oil prices until we bring that supply demand back into equilibrium. And based on the existing stockpiles we have and the existing production, outstripping demand by 30 million barrels a day, it's almost 1 billion barrels a month right now. We've got a long way to go in drawing down the storage and cutting production. Again, I don't think you're going to have to increase production again, in relation to demand until probably early 2022.
So did you happen to catch some of the latest Texas Railroad Commission's meetings on production allowables and the potential of shutting in, and what their take on it is to help this situation?
Yeah, I've read high-level articles. I try to stay out of Texas and leave Texas to everybody else. Just stay focused on the Rockies.
I avoid Texas when I can.
But I have seen that, and I just, I don't think that they should be telling operators to shut in production. I think,
allowables have happened in the past, though. When we had a glut in the 80s, there was a unified decision to allow production of certain assets versus others. So it's nothing new.
Yeah, but it is new when you talk about what's happening with COVID, you know, and the demand destruction that's happened, you know, now, you know, it is completely different, you know, and I can't really speak to, you know, the 80s. I'm not super familiar with, you know, what was the reasoning behind the Texas Railroad Commission doing that at that time, but I do know that.
Through the 80s, honey.
Yeah. I just made 30 under 30. Well, actually, just turned 30. I was born in 90, so. But, you know, I do know that there is some worry about, you know, if this could get Texas in trouble, you know.
In what way?
From, you know, some probably there's some antitrust issues surrounding that, you know, that I'm not sure, you know, everybody in, you know, Texas wants to, I think there's some concern about, you know, the legal ramifications of that. Again, I can't really speak to those too much, you know, but I think, you know, the markets are going to take care of themselves, and the operators are going to shut in production, you know, because they have to, because they're bleeding cash, because there's no, you know, more storage capacity left. And I think they're going to need to be told to shut in production.
So we have an interesting comment from Tricia Fanning. The regulatory environment in Colorado does not consider oil or gas left in the ground as waste anymore because of the passing of SB 181. Trying to have an intellectual conversation with our governor on the consumer economics is remotely painful. So there you go, a little comment about some of more of the impacts of 181 and the test case study that is Colorado. So
that's why we moved to Wyoming.
I know, everyone should go to Wyoming. Y'all have signs saying welcome oil and gas. The powder is the slow and steady player. I mean, God, underappreciated assets, man.
Yeah.
As we're wrapping up towards the end of this, I do have some questions for you about your thoughts on what this means for national security here. We as Americans, and as our various administrations have done over the last decade or two, we tout being the largest producer. We tout American oil independence. But I think what we have seen is that we never win in these oil wars because we don't control the global conventional tap. So what do you see this impact of this display that, you know, they turned on the tap and within a month we were on the downside of the coin. So what do you think these long-term ramifications are on a global perspective?
Yeah, again, I think, you know, OPEC saying that they're going to increase production briefly, that is added insult to injury. That didn't get us into the position we are today. You know, and you can flip what you just said onto its head, and rather, you know, than saying we're kind of at the mercy of OPEC, you know, I think that we've kind of broken OPEC. OPEC doesn't have the power that they used to have over prices. You know, the U.S. No, you know, they try to cut production, and then we just fill that production, and they're not getting the results that they want to see through their, you know, through their production cuts, because the U.S. just continues to produce and fill that up. And so it's
market share management. You reduce, I fill up.
I mean, they just enabled the U.S. to continue to produce, you know, so I think that we've actually essentially, you know, broken OPEC from that standpoint. The U.S. oil industry is kind of like a weed. I'm sure that's how they think about us. You know, we just won't go away. Nothing that we do is going to make us go away. You know, we come back stronger, you know, every time. And, you know, if you look at, you know, you talk about, you know, kind of the strength of the U.S., you know, in the face of the other OPEC members. And, you know, we are far more resilient than any of those countries. You know, what percentage of, you know, oil and gas makes up, you know, the U.S. GDP versus what percentage, you know, of the GDP in Saudi Arabia is made up by oil and gas, you know, or in Russia is made up in oil and gas. Mm-hmm. You know, we're far more resilient than those countries to swings in oil and gas prices and demand.
So it's been kind of interesting. We really haven't seen, we've seen the you know, the media channels on markets really commenting on what's been happening over the last 6 months in the oil and gas space, in the energy space. The administration has remained relatively quiet, and only recently is there a hint of potential tariffs or stimulus packages for oil and gas companies. So why do you think they're just now tuning in? Is something more going on? Did we miss something? Are tariffs really a possible answer?
I don't know. I thought that Trump was being pretty vocal about it. I mean, I heard that he brokered the OPEC deal.
I bet he had a hand in it.
Yeah. So I do think the U.S. has been pretty vocal about it. I think, imposing, tariffs on imports is probably a good idea. Obviously that production has already been priced in. That production that Saudi Arabia is moving over here, was priced in that month that it was reported. What isn't accounted for is obviously our storage, or lack thereof. So where do we put that oil that was essentially produced in a Brent market and put it in storage in a WTI marketplace? And the impact that that's going to have on price is not necessarily because of obviously the production, but because of the storage issue. And so, those tankers are probably going to hang out, floating, off the coast until, some sort of, decision is made on what to do with that. And if Trump decides to, impose some sort of tariff on those imports, then, those tankers will maybe, turn around and head to other markets.
So that's the thing, though, and I agree with you. But again, I don't know if tariffs, or even the threat of tariffs, is really that impactful right now, because the reality is the rest of the world does not care where their oil comes from so long as their pipelines are filled. The U.S., first world, we tend to be more diligent about the, that might be arguable too, but we tend to be more concerned socially about the location, the source of our imports. So, I mean, tariffs really, even if they come into play, do you think that they're just going to go somewhere else?
Yeah, I mean, they will go somewhere else, and I think this is kind of what you were saying, but I think bottom line is price. The companies, the domestic companies that are buying, Saudi Arabian oil, it's all about price point. And so, if those tariffs take away that competitive price advantage that Saudi Arabia has, then you're not going to see, domestic purchasers buying, crude out of there. And I think that's the intent, of the administration discussing tariffs is to level that playing field, and make, OPEC crude obviously, less attractive.
True. Just a quick note, got corrected by Ms. Paige Wilson. The Texas Railroad Commission has not cut oil production since the 1970s. It was not the 80s, but it did happen. So as we wrap up, Ms. Whitney Wickes, again, thank you so much for being here, but let's get some blunt and honest feedback out of you. The next couple of months are going to be hell. The next year is going to be hell. So where should we be hedging our bets, from individuals to companies, to what should we keep our eye out for? Where should we look for, the hidden surprise? What is your advice to industry right now?
Yeah. I think it's going to be a long recovery. This industry isn't for fair weather fans. If you're in it, you're in it. It's going to be a tough couple of years. And I think, we need to take some lessons that now in hindsight, we've learned about the last downturn, and as companies start to restructure, and go into default, they need to delever and they need to stay delevered. They shouldn't come out and, add back on this debt. I think, private equity obviously also not jumping in as much is going to help things, but we also, we need to invest in good management teams, and we need to invest in good rock. I think a lot of what happened coming out of last downturn is companies thought that they could make bad rock good rock with technology.
That's what fracking is, honey.
Yeah, which proved, but proved inefficient, and if you look at, so, the price point at which, oil needs to be at, to be in kind of equilibrium with supply and demand, assuming that's, let's say just somewhere in the foreseeable future between $50 and $65 a barrel. What percent of assets under management right now make money at those prices? It's not 100%. So the company is going to have to consolidate. And, you know, and you're going to see a lot of that, I think, coming out of, you know, this next 12 months. There's a lot of consolidation. There's going to be, you know, some winners and there's going to be some losers. But we need to be investing in good leadership at the top, you know, good rock, and kind of changing our strategy and looking at things from a more produce out mentality, you know, than looking at, you know, the potential exit strategy of, you know, buying, selling
strategy.
Because we've been really bad at trying to figure out what's low, you know, what's buying in low. Everyone thought that they're buying in low in the last downturn, which, you know, wasn't true.
So how do we all get one of those awesome hats you're rocking right now?
So these are super limited edition.
Because of the downturn or because of what's in stock?
Because of my marketing budget. Just kidding. No, if you want, so we've got a couple colors of these hats. So if you want one of these, just shoot me a message on LinkedIn, and I'll get you to rock a WW hat. We're actually going to do a fundraiser for Oilfield Helping Hands.
I would love to do that.
And put hats on there, not these hats, but different hats on there. I'm not going to give away the secret just yet because I don't want anybody to steal our idea. But I'll let you know when that's live as well, and you can pass that on to all your fans.
That would be awesome. Well, Whitney, we are at the end. Thank you so much for joining, because I know this was your very first podcast, and I know I completely tricked you into my very first live stream. So thank you so much for your acumen. I can't wait to catch back up with you in about, let's say, 2 months and see what your new market is. But again, this is awesome. So thank you so much.
Thanks, Kat, and thanks everybody who tuned in for this. I hope we didn't bore you, and hopefully said some enlightening things, or I said some enlightening things.
Absolutely.
If anybody, you know, wants any advice too, that's going through a downturn, I mean, not a downturn, but through a bankruptcy.
We're all in a downturn, man.
Shoot me a message. You know, happy to talk to everybody about that. You know, if anybody wants to learn more about my experiences through that, happy to share them.
Well, you have killer insight. So thank you so much, and we will catch back up with you soon. Talk to you later.
Thanks, Kat. Bye.
Bye.